SkyWest is the airline behind the airline. It doesn't sell you a ticket to Chicago, it just flies you there on behalf of United or Delta or Alaska under a contract that guarantees them a fee for every departure. The whole business runs that way. And right now, the stock is 30% off its peak. The interesting thing about this company is what happened to its margins. In early 2023, operating margins fell below 1%. Not 1% of revenue, barely 1% at all. Today, they're running above 15% for the full year, and the business hasn't changed. The contract's just started working again. That trough tells the whole story. SkyWest lost most of its pilots in the post-COVID hiring frenzy, which crushed flying hours, which destroyed margins. The stock fell to $16 in late 2022. Then contracts got renegotiated, margins recovered, and the stock ran to $121 in early 2025. Since then, it's given back about 30%. The analysis puts base fair value at $110. The stock is at $84. That sounds like a discount, and it is, but the deep value lens requires a 42% margin of safety, which puts the buy below at $64. So the gap isn't really between price and fair value, it's between price and what a cautious buyer would need to see to act. Here's what doesn't get enough attention. SkyWest has cut total debt by over $1 billion since the 2022 peak, down from $3.5 billion to $2.4 billion, and they're sitting on $707 million in cash and short-term investments. Leverage ratios are at decade lows. The balance sheet is the best argument for this company. The balance sheet scores 85, business quality 70, but free cash flow scores 45, and risk comes in at 40. The capex required to keep a fleet of jets flying is enormous, and it consumes most of the operating cash the company generates. Good business, expensive to run. So I asked what the model actually requires to get to $110 fair value. The answer was almost nothing heroic. Revenue barely growing, less than 1% per year. Operating margins holding at 13.3%, capital efficiency around $3 of revenue per dollar invested, discount rate of 11.7%. That's a picture of a steady, boring, cash-generating company improving slowly. The market is pricing it at about 25% less than that. The gap is the margin of safety requirement, not a fight about the business fundamentals. The bear case is the airline industry itself. A bad recession or a sustained fuel price spike could push margins back toward that sub 2% trough from early 2023. The watch item is quarterly operating margins. If they start trending back toward 11%, the bull case gets harder to make. Through a deep value lens, the verdict is watchlist. Confidence 72, base fair value $110, margin of safety 42%, buy below 64.56. The current price at 84 is above that level. That's a research judgment under a lens, not an instruction to do anything with it. The full analysis is at cersus.io. Stock analysis for modern investors.